Good afternoon, ladies and gentlemen. So today we're going to start a new lecture. This is a new topic for us, the Federal Reserve's response to the financial crisis. And in this lecture we're going to study, I'm going to make a sort of a reminder for you, especially in order to better understand the idea of the financial system and the monetary policy of the Federal Reserve. It is really good to revise some of the ideas, some of the points that we made during several months that we go through this course of studies. As you understand, this course of studies is just a volunteer seminar, so to speak, a workshop. And sometimes we discuss things in this class which are really sometimes really important. We've got students who come to these classes and they make presentations. And this is a really good thing for you to do some of these presentations. Well, today we're going to continue studying the Federal Reserve System and its response to the financial crisis of 2008-2010. As you remember, this crisis started started really earlier in the process, and it was really a harsh economic crisis, harsh financial crisis. It started in the subprime mortgages market, and this was a sector in the economy of the United States, and that was a sector that did many problems. That was a really harsh economic crisis, but it was this crisis has been being built through decades. Actually, it was not overnight that this crisis occurred. We know examples that some crises such as these cannot be unexpected. But people believed that there would never be any crisis such as the Great Depression. Before the crisis, people were really happy about the economic situation in the United States because the economy was growing at a really high speed and really great and high rates. Actually, this period and the beginning of the 21st century, this period was really a remarkable period for the US economy. And I feel like, people always believe when things go good, when things go excellent in their lives, in their personal careers, in their jobs, they feel like this time is never going to be stopped, actually. And this belief misleads them, and they start making mistakes. For example, like in this crisis in 2008-2010, before that crisis, people started taking and borrowing more and more credits and loans in order to buy homes, cars, computers, everything, and everyone was buying things on credits and loans. And that was a real problem, because as soon as the economic crisis began, as soon as it started, people realized that they've got no savings in order to be able to repay those debts back to the banks. The housing prices in the United States as well as across the whole world dropped dramatically, and they lost an opportunity or a possibility to earn additional money in order to finance their debts, in order to repay their debts. Now they were not secure and they had no savings in order to repay those loans back. And many people went bankrupt. And so this situation led directly to the financial crisis in the United States because people stopped purchasing goods and services they usually did purchase, and they started selling their things. There were a series of foreclosures. A regular day for a foreclosure was 800 families lost their homes, and during 2008 especially there was a whole wave of foreclosures. Bank agents came to your house and they put this table saying that your home is foreclosed. That means you are no longer the owner of this home, and they took these homes from you, and they started a new. So they had to survive somehow. They survived. They slept, for example, in their cars, and they just they drove to parking facilities, and there they slept. That was in America, as you maybe you know that in America it is forbidden to sleep on the parking facilities. This is forbidden, but anyway they did it because these were harsh economic conditions. They had no home, and they had no roof, so to speak, under their heads, and they had their own families, of course, and they had to feed their children, etc. So the situation was really difficult, and banks had to be rescued as well. And like you see here, the two main policy tools of the Federal Reserve System in order to save banks, in order to bail out the banks, these two great instruments were introduced again. They were implemented, they were used, and they were used really effectively. The government intervened, the Federal Reserve System, the Federal Reserve Bank intervened in this process. They started bailing out the banks. They started, they just started distributing or providing. They started providing the banks with additional cash, with the free flow of capital. And in exchange, banks gave to the Federal Reserve System their long-term assets, their long-term liabilities and the assets, because on the condition only that these particular assets and these particular liabilities are good and they can be taken as collateral. And some of the banks really had good collateral. They gave that collateral to the central bank, to the Federal Reserve System, and they received in exchange a free flow of capital, short-term liquidity. So that was a way of helping banks out of this difficult situation. It was made for the financial stability, and in this function, the lender of last resort, the central bank, was really an institution that helped the competitive banks to avoid bankruptcy, actually. And the situation was, like I said, the situation was really serious. Actually, only one serious bank collapsed, and that was Lehman Brothers. on September the 15th, 2008. There was the collapse of Lehman Brothers, and this collapse could have provoked the whole system to collapse, but there wasn't any situation like this, like it was in the Great Depression, when banks and enterprises were allowed to collapse, and 16,000 banks, competitive banks, collapsed during that financial crisis. Today's lecture, we are going to focus on some of the ideas during the financial crisis, the lender of last resort policy. This is just a plan. This is not for putting it down. This is just a plan for this lecture and the next one. Financial system vulnerabilities before the crisis included things such as, like I said, excessive leverage. People were in debt, were heavily in debt, and there was no system of monitoring the financial situation. This is really a serious issue. The system, monitoring system, when you monitor the financial system, is always good, because, in times of liberalization, when the government was not really concerned about the monitoring the financial system and the banks, financial corporations, they were not concerned about it because they believed the economic conditions were really good in the United States and in Europe, and the investment flow was really good, so there were because this was a period of economic boom, and these countries, their enterprises were really developing fast. There was also a really fast economic growth, and I believe that these countries in that period of time, they were the strongest. They produced something like 18% of the global GDP, and that was a real factor in the global economy. And before 2008, the global economy did not collapse completely due to the economic performance of these four nations, especially India and China. They did not allow the world economy collapse, because they stimulated economic growth, and they were the driving factors, the drivers actually of the economic growth during 2008-2010, when almost every country was in crisis. Actually, Brazil was hit hard by the economic crisis, and Russia as well. Russia was the worst hit economy in the BRICS, in these four nations. South Africa was not included then in 2008-2010. And I believe that the situation could have worsened if China did not perform so good, and India as well. Then there were several other nations which were called the next 11 nations, next 11 countries, which included countries such as Malaysia, Turkey, Mexico, Malaysia, Thailand, Singapore, 11 nations, Bangladesh, and countries such as these, mostly Southeast Asian countries, or countries that can be included or can be included here in the ASEAN countries, the Association of Southeast Asian Nations. The ASEAN countries, some of them are included in these new concept. It's this concept, next 11 countries, is just like the idea of the BRICS. So these countries are sort of going to be the next leaders in the world economy, plus the BRICS nations, that makes 11 plus 5, and that makes 16 countries. 16 emerging countries, the largest and the fastest growing nations in the emerging world. They are going to drive the economic growth in the global economy in the next in the 21st century. And these countries did not collapse in economic terms. There was still economic growth in these nations, and actually they hoped the growth not to stop. They helped a lot, and these countries provided liquidity to other countries, especially the least developed countries. China, for instance, provided credits to the developing countries and the least developed countries, especially in Africa and Asia, and they helped a lot in this particular issue. And these countries were not really vulnerable in this period. If we go back to the Federal Reserve System, so these countries were not vulnerable in economic terms. Maybe they were vulnerable. There were some trends in their economies that could be called not really transparent and not really stable. So some of these countries were a bit unstable, and their economic growth could not be sustainable in the longer period of time, and maybe their economic situation could have worsened due to a prolonged economic crisis in the developed countries, because the developed countries are mostly the consumers of their products. For example, the United States is a consumer or a buyer of goods from China, as well as Europe and many other developed countries. They are buying Chinese products because, they're cheap, and the labor force in China is really cheap, so American corporations produce their goods and services there in China, and then they export those goods to other countries, as well as the United States. And now the United States was in the crisis, the global financial crisis, and they started purchasing less products from abroad, and this directly hit export-oriented nations such as China, especially China, Germany. But Germany is a developed nation, but still it can be said that this is an export-oriented country, and they lost their external market. Almost lost their external market. They started having some difficulties, financial difficulties, but still they stayed afloat. Germany stayed afloat because they had their enterprises in China, in countries that were really booming, continued to boom. That helped a bit in that particular situation. That helped, and the other thing that the developed countries were really involved in this particular sort of financial crisis was that they issued a lot of derivatives, exotic financial instruments, and they were really drivers of the financial crisis in the United States and other European countries as well. Some of the public sector vulnerabilities may include things such as gaps in the regulatory structure. This is the problem of monitoring. Again, there were not there weren't any almost no there were almost no institutions, government institutions, that could help monitor the economic situation in the country. There were no government institutions that were responsible for the control of exotic financial derivatives. And now they started thinking about how to create these institutions, and these institutions started to appear. They issued the Dodd-Frank Act. In the United States, legislation is called by the names of people who create them. In Russia, this isn't. We don't have such a practice in Russia. All laws have their own names. They are named after the specific idea included in their contents. So our laws are called the way they are usually called in continental Europe. So no names of the politicians who created them. But in the United States, this is a tradition to name legislation after people who create them. Usually they name these laws after the names of senators in the US Senate, or some sort of other really politicians of high rank. So this was the Dodd-Frank legislation. Two people created this legislation, financial regulatory legislation, Dodd and Frank. Mr. Dodd and Mr. Frank came together and they started this process. The Dodd-Frank Act is a great document. It is really thick. It is something like 1,000 pages long, and in order to study this particular legislation and laws, you had to get a whole team of other scientists, a whole team of people responsible for the financial regulation in the United States. Many professionals, financial advisors. Well, this was not a really easy process. This was not an easy way to go. They had to go through all of the legislation that was made during the period of before the financial crisis. They had to revise some of the ideas in finance. They wanted to reintroduce some of the laws that were maybe not so good. They revised those laws, and they included many new things to control the regulatory system, the financial system in the United States, because there were real gaps in this country and in this country's legislation. They started providing some new opportunities for banks and corporations. They started purchasing their toxic assets instead of, or in exchange of collateral, good collateral, long-term liabilities and assets that could be taken as good collateral. And they did it, and that was really a good practice, and that was really a good policy in the United States. This policy was immediately taken by other European nations and by other developed nations. In Europe, in Japan, the government started creating their packages, stimulus packages. They were called stimulus packages actually. Not only the developed countries did that, many developing countries, including China, Russia, India, Brazil, and many other developing nations, started creating new policy tools, and one of these policy tools they started creating, developing some sort of reserve funds, and these reserve funds helped their economies to recover more quickly after the financial crisis or economic crisis that hit the world economy and many nations across the world. An important public sector vulnerability was they actually have 3 companies. In the United States there are 3 agencies which have really funny names: Fannie Mae and Freddie Mac, plus Ginnie Mae. These are 3 companies, home companies or mortgage companies. So what do they do? The US government created these 3 companies in order to help people buy homes. They are not government institutions, they are private institutions actually. They're not governmental, they're not state-owned enterprises. But what they do is they create derivatives, and they help people buy homes. So they securitize people's assets when they buy homes. This is their goal, and the United States government created these 3 institutions in order to assist the population of the United States to buy more homes. There was this great concept of own your own home, and this was an idea of in the United States. That was an American dream for everyone to own their own home, and they started building that kind of America, where each family had their own home. They were not interested in living in blocks of flats, and they started purchasing on the regular basis homes, separate homes in the suburbs, and they just took a drive to great cities, to the big cities, industrial, to their work. They go every day to work, and they work for those enterprises, they work for those firms, and they just and then they return back, and they live in their own home. So this system of mortgage was oriented or was aimed at providing each American family with their own home, their own separate single home. And they were really happy about that. And in order to assist the population of the United States in their doing this, the US government set up 3 enterprises. Like I said, Fannie Mae, Freddie Mac, and Ginnie Mae. 3 mortgage companies that did that securitization process. They secured assets and liabilities of the people who bought homes, who purchased homes. And when there was no enough, when the US people, some of the citizens, when some of them did not have, were not able to return to repay their loans and credits, their mortgages, these three companies, Ginnie Mae, Freddie Mac, and Fannie Mae, and they just intervened and they helped to securitize or insure all their assets. That was a really great system. That was a great opportunity for the US people to be sure about their credits and loans and their homes, so that they cannot be thrown away from their homes. And that was a really good economic policy tool. But there are some people in the United States, the poorer people actually, poor people, there are poor people in every nation on this planet, and I feel like they are just sort of people who cannot be provided with homes, that sort of homes in the first place. So they could have been provided with homes, but in other conditions. So these conditions, these particular facilities were not for them. But they were too optimistic about the general economic situation in the US economy, because, like I said, the US economy was growing. Inflation rates were not really high, and housing prices went up and up and up, and they were sure that this situation is going to happen in the future as well. They were not concerned about the future. That was the real problem. What I would like to say is that there are some people in any nation that should not be provided with credits. You should not allow them make borrowings, because they are sure to go bankrupt, and in turn this would create a really difficult problem for many other countries that are, in particular, these countries such as developing countries in this world. They are not going to be provided with additional capital in the end. MBS market, the mortgage-backed securities market, this is a sort of financial market, or a segment in the financial market, and the people and financial economists, financial advisors, financial managers who are working in this particular segment, in the segment of mortgage-backed securities. What they actually do is they buy and sell the assets and liabilities of people who own homes, who have taken loans and credits from banks, and they would like to be insured against some sort of economic collapse. When there is a crisis, they would just go bankrupt, and in order to stop that, in order to avoid this, Ginnie Mae, Freddie Mac, and Fannie Mae, these three companies secured their liabilities, and in this sort of way they could have been provided with additional sort of capital. But in this particular situation, before the financial crisis and after the financial crisis, well, these three mortgage-backed securities companies, and they also speculated. and they took some really toxic assets, and I think that that was also a reason for the economic collapse in the United States, because even institutions such as these, whose goals and functions are not really connected with financial market speculations, they actually participated and made a great contribution to spreading the economic crisis throughout the world, because these derivatives were taken as were taken for granted, and rating agencies rated them AAA. They gave them the highest rankings, the highest ratings, and everyone believed that these papers not going to collapse, and everyone was happy about that. Mortgage-backed securities were packaged in some sort of portfolios, and these portfolios were rated by the rating agencies as well. And if you had a security that was rated BBB, for instance, or CCC, when taken together or when packaged, these sort of securities could be rated AAA. What's behind this mechanism of rating such? But in the end, these three particular rating agencies, like I said, the Fitch, Standard & Poor's, and the Moody's, and they actually rated these toxic assets as AAA, and that was another factor, another driver in the economic collapse, in the financial system collapse in the United States, which led to financial difficulties and actually to the worst economic crisis since the Great Depression. Well, going further, Fannie and Freddie and Ginnie were permitted to operate with an adequate capital in their guarantees, and that was the point where they were mistaken in their policies. Their balance sheets grew rapidly, and because they purchased lots of MBS securities, mortgage-backed securities, they bought them in bulk, and their system, their policy was really wrong in that, because they provided credit and they provided loans to people who were not able to repay those loans in harsh economic conditions. So in normal times, in good times, when everything goes right, when the economy is growing, there is no really a difficulty in doing any sort of so you have not to worry about any situation or grave economic conditions in any of the markets in the United States. So everyone was happy, and every agency was happy. Each bank and each company, each firm, they were sure that this economic growth is going to continue. The party was going on, like they say. Like in the Roaring '20s, the party was on, and the people did not believe in any economic crisis. But suddenly everything collapsed on October 24th, 1929. That was the Black Thursday. And when the Black Thursday happened, and the New York Stock Exchange lost $50 billion in one day alone. And then there was a series of collapses, a series of downturns in the American economy, and it continued over all the way to 1941, when the United States entered the Second World War. That was a sort of belief that everything's going to be okay. Well, do people learn something from the economic crisis? This is really a good question. Do people learn something from crises from the past? Actually, there are several stages of learning. First, people do not want to learn, especially the political elite in the country. They do not want to admit that they were behind the economic problems that led the financial system to collapse and led the economic system to collapse as well. Because they feel responsible for the policies they did before the economic crisis, and this is why they are reluctant to say that they were behind those policy tools they implemented, and those policies, something went wrong in their policies, and I feel like that was a really great cause for them to continue to reverse their economic policies. They had to make amends, but they didn't, because there is this thing in people's heads and their minds, that if you do something, you should be doing it to the end. You should really be concerned about doing those things complete. You should complete those policies. And this is why the financial elite, the government elite, is reluctant to introduce some changes to their policies. But later on, when they realize that they were mistaken, and especially when new leaders come to power, this is a period when basically there comes a new leader to the government, and that leader creates a new team, and this team creates new laws. It creates new economic programs, new economic or national projects to help the economy get back on its feet. That was the situation in the United States when Roosevelt came to power after Herbert Hoover lost re-election. He was not re-elected, the President of the United States. Herbert Hoover was not re-elected, and Franklin Delano Roosevelt was elected. He was voted, and he was confirmed as president in 1933, I believe. He started his government. He created new laws. He started new economic policy that was called the New Deal. There were several points, really important points in his policies, and these his policies helped the US economy get back on its feet. There were, of course, some mistakes in his policy, but the greatest reform, so to speak, the greatest idea of the team behind him, the economic advisors of his, they created this new deal policy, and one of the national projects was to set up a corporation that would ensure deposits of every American in the bank. And this corporation still exists, and it is called FDIC, the Federal Deposit Insurance Corporation. So this corporation is responsible for insuring your deposits in banks. And this immediately led people to believe in the banking system, to trust their banking system, and they did not withdraw money again. Instead they came to their banks and they deposited, they opened up new accounts, and this helped the economic system, the banking system, to stabilize, and people were really happy about that. And the banking system as well, because the banking system received free cash, and the banking system received capital, and that was really good for the economy. A key trigger of the economic collapse in the United States was bad mortgage products and practices. So like I said, there were many exotic papers in circulation in the United States, and people were just attracted by colorful advertisements and really attractive rates for their mortgages. For example, there were companies that offered great opportunities, and they provided cash, and they provided loans at zero rates in the first year. They were not saying that they're going to change their rates next year or in 2 years' time. So people believed that they're going to have the same sort of conditions throughout decades when they repay their loans and credits without any rates being charged. But they were mistaken. That sort of situation was in Russia as well, and we still have this sort of marketing policy tool in the banking system when they say that you're not going to pay any rates, you're not going to pay any interest to the bank, you will receive your credit loan at zero interest rate, which was not true, because no bank is going to work freely, and nobody is going to take things as they are. And of course there may be some sort of cheap credits, but still an interest rate should be charged, because an interest rate is the basis and the foundation of any banking system in any country in this world. And I feel sort of concerned when I hear people say that I would like to buy a car, and my credit is going to be really attractive because I will not have to pay any interest rates, and everything will be alright. But I always say to those people that it is impossible for a bank to provide you with free cash. This is just impossible, because this bank lives having your interest rates. You are actually a person who provides banks with additional capital, and it is impossible for a bank to survive. Well, banks may of course make. Well, a special point in mortgage-backed securities in the United States in this period was that the banks did not require any documents from you, so you did not have to submit some of the documents that are usually given to banks when they provide you with cash, provide you with loans and credits. That was a 2000 practice. In the early 2000s, and just before the 21st century, in late in late 20th century, in the beginning of the 21st century, banks practices were liberalized, and banks were free in their investment decisions, and they did not require some important documents which they required, which they demanded in the 1980s, for example. In the 1980s, a mortgage was a really expensive thing. 33-year mortgage was something like 18% annually on an annual basis, and people were really concerned when they were more responsible for their actions, I would say, because when you see that this loan is really expensive, you're going to think first, should you really would you be able to repay those loans and credits bank to the bank when when your liabilities are due, when your mortgage-backed securities are due, and you have to make payments, and otherwise you go just bankrupt and nobody is going to bail you out in that sort of particular situation. Well, people were afraid, and they were aware that in any situation such as these, in financial difficulties, a bank could come to your doorstep and say that your home is foreclosed. I would like to add here a certain point that they after the 1980s, by the end of the 1990s and the early 2000s, bank practices were really liberalized, and their banking practices became sort of lax. So they introduced lax policies, really flexible financial rules, and these flexible rules allowed the banks making loans to people with no documentation, with unstable incomes, especially the unstable income. So that was the problem in the year's economy. Banks provided people with cash, the people with poor economic conditions, with unstable incomes, which cannot be sustained over longer periods of time. And mortgage-backed security, and actually a mortgage, is a long-term project. It cannot be repaid in 1 year. Usually in the United States, a standard mortgage project is something like 33 years on average. They just divide up their mortgage plans into many periods, just like any bank does in any other country. In Russia, we've got the same practice. They just divide up their period into small time frames, and they pay back their loans and credits during these time frames. That is well known. Generally, this practice is generally considered an effective practice. But the difficulty is that you've got to have stable income through this whole period, 33-year period, and this is really a difficult period. That would be a difficult period for you, because you may be killed, you may die, or something else would happen. You may be laid out, or you may be made redundant. So many situations, you may be unemployed. Many situations, many social problems may occur. You may just get ill, catch some kind of some sort of flu, so, or you maybe you may be hit by a car and become an invalid. So there are many difficulties on your path and in your life that could change everything. And 33-year period is too long, and you should be really aware about you should be really aware of the responsibility which you take upon your shoulders when taking such expensive loans, mortgages. But in the early 2000s, people were really happy because banks started, the banking activities, the banking business was liberalized, and banks were allowed to provide you, the population, with cash freely almost. They provided loans at low interest rates. They required almost no documentation, and they also provided you with additional home opportunities, additional financial resources. For example, after a year of your mortgage, when your home grew in its value, they would just give you up to this particular value some sort of package, financial package, and they would give you another loan up to $5,000, for instance, to buy a new car or build a garage, to build it just in your home. So that was a real problem for the United States, and you could see advertisements such as these. You see here a happy family and conditions under which the bank provides you with loans and credits. You could save money with the combo loan. Combo loan could be understood as a combination loan, where each product, each component of the financial product of your mortgage is combined into one package. Low monthly payments, so you do not have to pay too much money on a monthly basis. 4 out of 5 approved, 4 out of 5 credits and loans is approved or has been approved already for you, or made for you already. No upfront cost or obligation, so you do not have to pay anything as collateral. You do not have to give anything as any money to them. Loans for homeowners with less than perfect credit. So they provided really flexible opportunities for you to buy a home, and they did it really successful. Their marketing campaigns advertising campaigns were really effective. People started taking loans and started buying homes in the United States on a grand scale. Another advertisement, 1% low start rate. So this 1% start rate you pay as interest to the bank in the first year. They do not say that they're going to increase your interest rates in the second and the third year. This is sort of a trap in this kind of loan. Because when the second year comes and they tell you that you're going to pay to repay your mortgage at a higher rate. Stated income. What is a stated income actually? It says that you just tell them what your income is. You may lie to them. You may say, I'm paid $1,000 a month, or I'm paid $1,000 a week. These sort of things, and they would just believe you and take your words for granted. No documentation loans. So that means you do not have to provide them with any sort of documents um, which could say that your income is not sufficient, or you've got some job problems, maybe you're just unemployed. 100 finance available, that means you just take 100% loan and you buy a home immediately. On this particular day you just move into your new home and you start a new life. Debt consolidation. This is a really interesting thing, debt consolidation. They offered you an opportunity to collect all your other debts on one account. Just accumulate each and every piece of debt of yours on one account, together with home loans which they provided. So these were the deterioration of lending practices. And then comes the financing of exotic and subprime mortgages. When the banking practices are flexible and everything is liberalized, they feel sure about the future and things, again, I repeat, I remind you that during such periods people do not believe that something bad is going to happen. Actually, nothing bad is going to happen, and I believe that people sometimes just do not want to believe in reality. They are really optimistic. I think that the majority of population in any country are optimists, and only a few people, really few people there are in any nation that are pragmatic and or pessimistic about the future. And these people are really sensitive about economic conditions, about their incomes. They would think lots of times before actually buying into homes or buying into mortgages, because again I say they are really concerned about their future, whereas optimists do not think about this at all. They are sure that everything is going to happen the way it happened in the past, with no black dots in their careers and their life. Some of the securities that were created in this sort of way, exotic securities, they were created in terms of GSE structured securities, and then there were of course some CDOs and MBS papers and many other things, many other securities which were used as basis for the specific situation, financial conditions on the mortgage market. These exotic papers, for example CDOs, collateral debt obligations, were used as sort of collateral, like the word said, like the phrase is, it contains this sort of thing, collateralized debt obligation. That means it is collateralized, it is backed by some sort of collateral, some real asset that is included in this paper, and this paper is really insured, and the bank is sure to receive its money in the end. And they, or not just banks of course, but these three corporations which we mentioned already in the beginning, Ginnie Mae, Freddie Mac and Fannie Mae. These three corporations, they also operated with these sort of exotic papers or derivatives, For example, the CDOs, collateralized debt obligations. And these papers were rated AAA. They were given high rankings, high ratings by the Moody's, by the Standard & Poor's and Fitch. These three companies, like I said, the Moody's, the Standard & Poor's and the Fitch, are the greatest companies, rating companies in the world. They take 90% of the global rating, financial rating industry. 90% of the whole global rating industry is in the hands of these three corporations. Moody's and Standard & Poor's, they just taken together, they've got almost 60%, more than 60% actually, more than 80%, yeah. More than 80% of the credit rating market, more than 80% between them, 40 to 40. And Fitch is some sort of 16 to 18, so that makes more than 90% of credit rating industry is in the hands of these three rating agencies. Then, of course, there are other small enterprises, small rating agencies, but they are not their opinions are not really taken into account. Well, each company is rated this way using letters. Usually, they can be double letters, triple letters. AAA is the highest rating for a company. And the securities, commercial paper of these sort of companies is the most secure one, paper or share. And investors should feel confident when they invest their money into these liabilities, into this debt. And in this particular situation was the same thing. Investors and banks were sure that these products are secure and they could buy into them. And they actually bought them in bulk. And this is the reason when the economic crisis, the financial crisis started, when mortgages started to fail and banks went without their money. So this whole market just collapsed like a house of cards. And the system was really shaky and really vulnerable in the end. The financing of exotic and subprime mortgages, when these papers were sold to investors, there was a great problem that many of these papers were toxic and they were not real. There were no real assets behind them. The only real asset which you could have was a home, and it was taken immediately as and it was foreclosed. Financial institutions also retained some of the securities. They kept them on their vaults and their accounts, and banks were really sure that these products, after being rated AAA, BBB, they were good investment products as they thought, and sometimes they created off-balance products, off-balance sheet vehicles financed by cheap short-term funding like commercial paper. Yeah, and that was a real problem. That was a real trap for banks. To say that banks were not aware, were completely unaware of the economic and financial situation, I don't believe this. This is not possible. It is just an excuse for them in their banking practices when they say that these products were rated AAA and this is the reason why we bought them. I don't believe this. It cannot be true, because in any bank there are financial analysts who are really competitive and who are really smart financiers and smart bankers, professional bankers who know everything about financial products, about financial derivatives and things like that. So they cannot be mistaken in their investment decisions in this particular way. When they say again that we were unaware of these particular papers and they were rated AAA and that's why we bought them, again it leads to specific questions as to their professional skills and responsibilities and many other competence. I don't believe this. I feel like they just thought it all up as an excuse, and there were many, I think, bankers and financiers who knew that this economic collapse was going to happen, and they were just made silent because banks speculated and they made large amounts of money out of this particular business. And this business was really profitable for them, and they used many of these collateralized debt obligations in order to finance their activities abroad. They sold and resold these collateralized debt obligations to other banks, and in this way each and every bank was in sort of web where every bank was dependent upon the other bank, and one bank was influenced by financial activities of another bank, and in this sort of way, when one bank just collapsed like Lehman Brothers, each and every other bank could collapse as well. And at this point the US government on behalf of the Federal Reserve System stepped in and started providing cash to banks so that they did not collapse, and when the bank collapses again it could collapse another bank, and the whole financial system, the whole monetary system of a country may collapse as well. And in this sort of way I feel like they were aware of this particular crisis, that it's going to happen, but they just were made silent by their bosses, by their clients. For example, rating agencies, why were they silent? These credit rating agencies. Well, this is also simple. They were paid money. Rating agencies are paid for rating commercial papers, for rating CDOs and all those things. They are paid for this. And so when people come to you and say, I would pay to you money and you just rate my commercial paper or my CDOs, who would refuse? They received much money from that particular business, and who's going to refuse that? Nobody actually is going to refuse lots of money. When money is coming to you, you just take it for granted, or just as it is. And the professionals who told their bosses, their financial directors, or their CEO, chief financial officers, or chief executive officers, or just the board of governors at the meeting of the board of governors of any corporation, of course they said that they're going to be an economic or financial collapse and you have got to do something about this. But they did not do anything because they received lots of money. millions and hundreds of millions of dollars, and maybe billions of dollars were incomes of in the financial industry. The financial industry in the early 2000s became the most profitable industry in the world, in any economy, in any developed economy, because due to this financial liberalization and financial globalization. These two processes made things really work in that way, and I feel sure that he could avoid this financial crisis, but for the people who were behind those policies, he could not make a stop to their financial activities, and he could not ensure the liabilities, could not provide cash opportunities, but they were doing it on a large scale. They just sort of went crazy about the things which they did, and that was the point behind, that was the problem behind this particular economic situation. They had people who, they of course had some professionals again, but they did not, they made them keep their mums, and that was really an important driver in spreading the financial crisis in the world economy, when each and every bank was under threat of financial collapse. So today we learned a lot about the policies which were taken, and some of the reasons, some of the factors for financial crisis in the United States, and the way the year's Federal Reserve system, Federal Reserve banking system dealt with. And they actually dealt with it really successful. When we compare the periods of the Great Depression of 1929-1933 and the Great Crisis, the Great Financial Crisis of 2008-2010, the Federal Reserve System was really successful during this recent crisis of 2008-2010. So they learned a lot of things from the Great Depression, and they implemented some of the policies they did not use during the Great Depression. And that was the reason why the global financial system, the global financial architecture did not collapse. It did not collapse due to these sort of policies which the Federal Reserve provided. And I believe that was really good. And despite many criticism in the financial industry, when they say that banks are robbers, the banks are just robbing the population out of all their savings, do not believe them. The central banking system actually was the greatest factor and the greatest